All right. In today's video, we are speaking to David Hunter, and David's become one of my favorite regular guests to talk to. He's become a bit of an offline friend and one of the more fascinating people that I get to talk to because he has correctly predicted, said we're not having a market crash right now. We're going to have essentially more of a crack up boom, an inflation trade. And we're seeing this starting to play itself out more and more. Although the wheels were rolling a little bit back and forth with the shift from presidential administrations and people unsure of what's really happening in the world. And so we're going to be discussing that. We're going to be discussing investments, gold, silver, commodities, lots of amazing stuff today. So give us a comment down below that says David Hunter rules right there down below. David Hunter rules in the comments. If you haven't yet, please make sure you hit the like button on this side or this side right over there. That'll send this video out to more people. You'll see David's Twitter right there down below, and you can reach out to him for his investment newsletter. Also, just want to get a shout out to our channel sponsor, which is Vizsla Silver, one of my favorite silver mining stocks. So be sure to check out Vizsla Silver, and want to welcome you to the show today, David.
Jake, how are you? It's always good to come on with you.
Yeah, it's always fun talking to you. So I'm doing good. I'm doing good. Starting to see the signs of. I mean, we have been, but really starting to see the signs of this melt up. And it was kind of a precarious position because there is so much insecurity. No one really knows, and then having to switch administrations kind of put everything on the back burner. And of course, there's a lot of rhetoric about taxes and other things that have had some impact. So give us an idea of where you think we're at right now, and we'll go from there.
Actually, I think today is good timing because we
Yeah.
kind of had a day or two crack up there where the market loves to test people's convictions, and right now I don't think there's a lot of conviction. I think, as you say, people just aren't sure where they are. What I find from the professionals is that they're everybody's calling for a top of some sort at some point now or later this year or what have you. And I think so everybody's kind of looking for that exit point, and I see the retail kind of in the same place, with one leg out the door, kind of figuring out when do we sell. They're not necessarily saying they're selling right now, but they're nervous.
Right.
And then you get days like yesterday and the day before, and people really quickly start shifting to, hey, maybe the top's in, maybe we've already seen the highs. What do I do here? I'm nervous, or they don't even have to say it. You can tell everybody's very nervous. And I view that as, and I've said this really, as you know, through the last year, there's been a wall of worry throughout this thing. And I just think that wall of worry still is intact. It's amazing. You can be up 80 plus percent in a year and still have people as nervous as they are, because normally psychology has you moving more towards the bullish side as you move up. And I hear everybody saying, oh, everybody's all in, everybody's bullish. You couldn't tell that from the panic that you saw yesterday. At least on Twitter, there were an awful lot of people questioning whether this thing could go any higher. And so that keeps me bullish. I think sentiment is a big part of what I look at. Just from a kind of seat of the pants standpoint, sentiment is still, in my opinion, pretty cautious. So doesn't mean people aren't invested. Doesn't mean we haven't seen a lot of money come in the last year, but it does mean I think there's still plenty of runway ahead. I remain of the view that we'll see the S&P up to at least 4,700, the Dow up to 38,000, and the Nasdaq up to at least 17,000. As I've said before, I'm pretty sure those numbers are going to prove conservative. So I'm not ready to raise them, but I'm also pretty confident that those are minimum expectations.
So let's talk a little bit about kind of, if you will, timeline. And I use that word hesitantly because you said when everyone was saying this thing's going down, this runs over, you were saying no, we're gonna have another stage of this melt up. And it's been kind of, as you said, off and on. And it seems like we're really getting these wheels screwed on correctly now. And the hardest thing is, of course, to predict a timeline. And it seems like everything you've been discussing, it kind of got pushed back a little bit. And so I wonder where you stand on how long you think this inflation trade or crack up boom can go, because we also have many places starting to reopen, and we have I mean, maybe in some sense some pent up demand, or we have stimulus coming in. And I'm curious how long you think this season can move for, and has your views changed on how long this may be able to last? And for those that are unfamiliar with your work, the reason I said that is because you think we have a big melt up followed by a deflationary bust. So I'm just wondering where you stand on that.
Yeah, my view hasn't changed much. And anybody that's you followed me for a couple of years, anybody that's followed me knows I have a tendency to um, put possibilities out there as targets. Say, well, the market could reach a top in the second quarter, for example, or whatever. And that word "could" is an important word. I'm not saying it will. People may think I'm just kind of hedging, but it's just the reality that cycles take time and they play out kind of on their own, ebb and flow. So if everything falls into place, we could see a top this quarter. It could spill over into the third quarter. I'm pretty sure we're going to see a top in the market second or third quarter. Could it? Could things drag out beyond that? Sure. But I look at inflation heating up. I look at the economy opening up and heating up. And those are things that are going to ultimately move the Fed towards tightening. They may be talking about no tightening for another year. They may be saying we won't raise rates until 2023 or end of 2022. And I think Powell's being sincere about what he sees or what he plans. But things change, and I don't think he's trying to pull a fast one on people and tell them something and then surprise them. I really think he's telling you what he thinks, but I think he doesn't realize the likelihood that inflation here is going to be picking up speed to a point that by the time you get into the mid third quarter, by the time you get into the summer, you're going to have a hard time making the case. Look at already. We've had rhetoric in the last couple weeks since in the last week since the Fed meeting about lots of news, lots of talk coming out of Wall Street about whether rates are going to they're going to have to raise rates sooner and all of that. So people are aware inflation's starting to pick up. He's calling it transitory. I don't think it's ultimately, some of it is transitory, but I think also there's some real overheating inflation being built in here. And that's ultimately what I think ends the cycle, is the Fed having to tighten. And I would argue that you're going to see that tightening before the end of the third quarter. Whether we top, this quarter or next quarter, to me is, it's guesswork. But I think we're pretty close. And keep in mind, as I've said to you before, this is a top of a 39-year secular bull market. So, I don't pretend to be able to tell you ahead of time which month or, within a couple months. I have my best guesses. But, if I can get it anywhere near close on 39 years, I'll be happy. So yeah, I think we're pretty close. We're within a quarter, probably, of a top. Now that's the stock market. The economy lags that, or the stock market leads the economy. So the top in the economy is probably a fourth quarter event, in my guess. Could spill into next year, but more likely it's end of the third quarter or fourth quarter before we see the economy starting to roll over, because that's going to depend, I think, on the Fed having to start shrinking the balance sheet, QT, quantitative tightening. I don't think we're going to see the Fed raise rates but the market will take care of that. I have a forecast of a 2.5% 10-year sometime over the next several months. I think we go to 1.20, 1.2% on the 10-year first. We're somewhere down under 1.6 now, I think. So you have a bit of a rally in bonds here first, but then that rally ends, and you get another backup in rates beyond the 1.75% up to maybe 2.5. 30-year probably goes up to the 30-year bond probably goes up to 3%. So it's not the Fed raising rates; it's the market raising rates that I think is part of this as well.
So we've seen quite a bit of rhetoric, and many of the main even news and financial channels are now even discussing inflation a lot. And I'm not talking YouTube channels. I'm talking real television channels. And it seems like every day some new swamp creature is floated out to tell us that inflation is transitory. And it's both sides of the political spectrum. And so it's happening so much now that it makes me sit back and go, why are they telling us this so much? And then I drove into California here to visit my family, and gas is basically $5.
Wow.
And, if you how do you afford that if you're making 30,000 a year, you lost your job and you're relying on stimulus? So it seems to me like they're maybe floating this out because they're really aware that this can have a devastating impact on a lot of people. Or what do you make of it?
Yeah, for sure. As much as I say that Jay Powell is being straightforward with people, that he's telling them transparently what he is thinking, I do think he also has a tough job on his hands because he does not want to be somebody that creates a rollover in the economy because he misspoke. So certainly he doesn't want to push the idea that the cycle's coming to an end, that tightening's coming sooner, because, as he says, there's still an awful lot of people out there that are not working, that are still suffering from the pandemic. So there is some of that, I'm sure. Not so much that he's telling a fib or telling you what he doesn't believe, but he's certainly got reason to want to keep both the market and the economy calm, the market and people calm. So that's from the Fed standpoint. When Janet Yellen spoke the other day and talked about the possibility rates might have to go up a bit, I think she again is doing her job. They know, they don't. People got all excited and said, "Oh, Janet Yellen thinks rates are going up. Rates are going up." And I go, "She's not in control of the Fed. She's Treasury Secretary, so she's just giving you her view, and it's a realistic view to think that with inflation picking up and the economy opening up and looking like it's getting more heated, that yes, of course, rates are going to go up. And like I said, I have that forecast, but not right away. I really don't, I don't think it's so much a lot of jawboning, worrying about people, trying to keep people optimistic. I think it's just really most of the voices I hear from the Fed and maybe a couple administration people, but I don't think there's so much of that going on. I do think there's a lot of Wall Street concern about inflation and so you get a lot of back and forth about, is inflation going to push rates higher here? Are rates going to 2%? Are they going up or down? I view that as typical Wall Street. So, but I get your point in terms of gas prices. I do think gas prices are going to moderate some of what's going on in the economy. It's got to hit the consumer's pocketbook to some extent, but the consumer still, you look at the numbers, savings has never been this high. The consumer is still benefiting from the huge fiscal stimulus that we've gotten, the relief checks, et cetera. So I think that that becomes a problem a little farther down the road, probably by the time we get through the third quarter into the fourth. then I think, yeah, you can start talking about how that's going to start hurting the consumer.
So what does it look like when, you're under your opinion is that they start tapering or what have you? How does that affect a not only an economy or a stock market, but a society that has become 100% dependent on this easy or free money? What are the effects of something like that?
Yeah, well, let's keep in mind we're talking about, if I'm right on rates, we're talking about a 2.5% 10-year. You know, go back 2 years and you would have thought 2.5% was a bargain. So it's not like the old days when we were at 6, 7, 8, 9%, or back in the early 80s, 12, 14, 15%. So we're not talking that. What I think, the fact that you can take rates up to 2.5, and that I consider that having the ability to turn an upturn into a bust, says a lot. I think it says more about how fragile this recovery is. And it's fragile for two reasons. It's fragile because of all the leverage that's been, it's really decades in the building, but we've got 250 plus trillion dollars in the global economy of debt. And as I've said before, you have quadrillions in notional value of derivatives. So you have two kinds of leverage out there that are telling you you've got a very risky both market and economy in terms of leverage. When things are going up, leverage enhances whatever it is that's happening, on the upside. When things turn down, leverage exacerbates the downturn. So that leverage is added risk, and there's a lot of added risk. We've never been at these kind of levels of debt before. So that's one side of the fragility. The other part of the fragility is we just came through something we've never seen in history. A global economy basically shut down. People closed up in their houses, schools closed down, etc. It's taken its toll both on people having lost jobs, but also on a lot of other aspects of people's confidence in living. And so, it doesn't take much. And it's also, you've got landlords not collecting rent because the government says there's a moratorium. If people can't pay their rent, they don't have to, or mortgage payments, banks aren't getting paid. And the government says that's okay because we're trying to get through this. Those are all pieces of what I call fragility in an economy. And again, it's not just in the US, it's even worse overseas in lots of ways. So if you get to a point where the Fed has to tighten, it doesn't take a lot of tightening, in my opinion, not the kind of tightening it normally would take, to turn what looks like an okay economy into something that's pretty god awful.
Yeah, so that's you hit on something that I've wondered aloud about, which is it is very understated how many people are not paying their rent and how many people are not paying their mortgage. And of course, you can find some, maybe fairly accurate data on it, but it's not like it's ever discussed in mainstream channels. I mean, you don't even hear either the president or the Fed discuss it. I mean, there's a lot of people that haven't paid their rent or mortgage in 14 months. And then when you look at the rent side, well, then that means that the landlord's stuck with it. So then if the landlord's not paying, so it's this very big situation that is rarely discussed. And I just wonder, how does that even play itself out?
Yeah, I think it's an excellent point, Jake. It's, again, I kind of sum it all up in terms of saying the economy and the system is very fragile, but we've never seen this before, and we're really talking about, and I'll just focus on the United States, but we're really talking about a complete change in how we're viewing the social, the contract. It's like, yeah, you signed a lease, and yes, you promised to pay your rent every month, and if you don't, there are consequences. Well, not right now, there aren't. If you signed a mortgage, well, that if you don't pay your mortgage, with some time lag, they're going to come and foreclose on you. Well, right now they're not. So it's just, we're really, and again, it's part of this period of time. You're absolutely right. Nobody's talking about it, but it is what I think is going to be the wake up call is I think there are people in the government and on one side of the political spectrum that really think they they don't really think through. It's not just that, hey, you know the guy that owns the home, that owns the apartment building, it you know can wait for his rent. He has that building, um, typically with a mortgage on it. So he has to pay his mortgage and he's not getting the cash flow to pay his mortgage. It trickles on through to the banks. We're not seeing it yet in terms of the bad debts, but all of that's going to build up and come crashing down at some point. And again, if we had an end to this and you could say, yeah, there's a finite, 1 year period and then everything returns to normal and we can kind of have people catch up on their rents over the next several months. But how do you ever catch up from a hole like this? People who didn't pay their rent and were told they didn't have to pay their rent for a year, maybe they couldn't, but you don't just all of a sudden say, yeah, I got my job back and now I'm going to, make up those 12 months worth of rent. It just doesn't happen that way. So right now it feels like, gee, there's cash coming from everywhere. The government's handing you checks. If you have a few kids and you're married, you might have gotten $5,700 in the last relief check. It feels like, gee, we're doing well. And then you've got a certain administration talking, universal income. And, we're changing the fabric of our economy. We're moving from capitalism to socialism without really even people thinking about it. And I think there is a wake up call on that. But that's, you know, even if you take that out of the equation, just the fact that we are fragile means that when they do tighten, as happens in every recession, what precedes a recession is Fed tightening. When they do tighten, I think we're going to be surprised at how fast this one turns over. Sometimes you tighten for a year before you see the reaction in the economy. This one, I think the reaction is going to be very quick.
Yeah, speaking about free money or easy money. So I went into my favorite restaurant in town in Utah and I quit eating there at the restaurant because it's a very nice restaurant, but they serve everything with plastic plates and forks. And so I quit going there. And I talked to the manager and I said, "Hey, you guys got to get your glass. I'm not going to come and spend, a bunch of money for eating with plastic." And he said, "Yeah, we'll have it next week." And it's probably been 2 months now. And so I went back and I said, "Do you guys have it yet?" And he said, "No." And I said, I made a joke. I said, "Too much stimulus money?" And he looked at me with a straight face and he said, "Yes. No one will take our job. It's been 2 months." Because why would you go work there? I mean, you don't need it. He said that it's why they haven't been able to get their job filled. And so whether it's the domino effect of people not paying rent or mortgage, or then you look to the other side at the employment, it's almost like we're living in a house with the windows busted out, with holes in the wall. The electricity doesn't work, but you have a blindfold on, so you don't realize where you're living.
Absolutely. Yeah, no, I agree. And it is a real problem that we're paying $600 a week in unemployment. So the people at the lower end of the scale, the ones that are usually in those part-time jobs or minimum wage jobs, they say, why am I going to do that? If I go back to work, I lose this $600 a week, and I'm not going to make nearly that much. So we're incentivizing people not to work, and I get it. There are some people that need it, but there's an awful lot of people kind of living off off the trough right now that really should be back at work. And it's, I mean, pandemic is a whole different issue, and people have to look out for their health, et cetera. But I think we are, as always happens, the government, even when they mean well, can create a lot of unintended consequences.
So, what do you see? You talked about a 39-year, essentially debt super cycle coming to an end. Um, what's on the other side of it?
Yeah, I want to correct that because it's a 39-year um, bull market in the stock market. I am not in the camp that says this is the top of the debt super cycle.
Got it.
Believe it or not, because of the bust, and we haven't talked much about it this time, but because I expect an 80% bear market or 70-80% bear market, and what I describe as a bust that will be the biggest downturn in the post World War II era, bigger than 2008-9. And I think that begins late this year and carries through next year. Because of that, there will be, if we think what we've seen so far in terms of the government relief is big, just wait. Because what will come on the other side of in response to the bust will be money like we've never seen. So we've grown the Fed's balance sheet to $7.5 trillion. I believe in response to the bust, it will grow to over 20 trillion because that's what it'll take to keep the system from imploding. And you'll have similar expansion in treasury debt, in government debt. And again, I'm talking US, but it's around the world, similar proportional type stuff. So what that means is you're going to have a involuntary debt liquidation cycle in the bust, meaning a lot of bankruptcies in the oil patch and in junk bonds, et cetera. But because of the sovereign response, the sovereign debt response, you're going to have another big leg up in debt. So by the end of this decade, I think you may go from 250 trillion at the peak, this cycle, to something closer to 350 or 400 trillion at the end of the decade. Most of it soon after the bust. Most of it in the couple of years following the bust, trying to get us out of the hole. So I think the debt peak is still one more cycle out, or one more recovery out, and then I think it all you get the true crescendo crash where it's the end of a super cycle. But so the stock market makes its peak now. You won't see highs beyond this cycle's highs, but the debt peak will be another 7 or 8 years out.
Interesting. And how do you think that this affects commodities? Right? You talk about gold, you talk about silver, you talk about commodities, you talked about oil. So what's the impact on all this?
Yeah. So that response to the bust, we've got inflation this year, and I think it's going to get bigger before it gets smaller. So we'll have more inflation building up through the summer. I'm calling for oil to get to $75 a barrel, or a little more, probably by sometime this summer. So we're at 60 now. So maybe another 65 now, maybe another $10 up. I'm not sure it's straight from here. I actually think we'll pull back in oil, maybe get to the low 50s and then make the run to 75. But either way, I think oil has higher highs from here. Copper is going to go higher, gold's going to go higher here. So you're going to have a mini inflation boom that we're already starting, obviously, between now and fourth quarter. But then the bust, I call it deflationary bust, because I think it's going to be such a bad downturn that it will take this mini inflation boom and turn it all the way into negative. So we'll have negative inflation next year. And then from there, because of the response to the bust, you get a big commodity cycle. And you'll have a big inflation cycle beginning in probably 2023, starts slow. And then by the time you're in the late 2020s, you'll have gold at 10,000, you'll have silver at 300 plus, you'll have oil at 300 plus. You'll have copper, 5 times its current price. You'll have natural gas through the roof. You'll have gasoline prices in the double digits. So we'll have a big inflation boom like we haven't had since the 1970s. And how that all plays out for the consumer, it's hard to believe the consumer will be on its feet if you have all of that. But there'll be wages going up and things, but with a lag. So I'm not sure how all that plays out, but I think that's what we're set up for. As you've spent 40 years disinflating the economy, because of the bust, you go, the party always goes too far. Because of the bust, it'll go into negative territory next year, negative inflation. And then because of the response to that, you get this massive, one less than 1 decade long inflation boom. And then that becomes the real problem out 6, 7, 8 years.
So do you think that's after this bust? Because I wonder, how does it look from a government perspective? So do you think that's when they step in and infrastructure bills go all over the place, and that's when they just essentially put the printing presses into superdrive?
Yeah, that's the other side of. I mean, that's the equivalent of the. Let's say the balance sheet goes from 7.5 trillion to 20 some odd trillion, so you've got another, say, 12 to 15 trillion in money to spend that's pumped into the system. The other side of that is what the Treasury does. So you'll see our government debt go through the roof, and then that government debt obviously raises proceeds to pay for everything. They'll be using those proceeds to build roads and bridges, improve the infrastructure, do green, the Green New Deal, all of those things and more. But they'll also be using it, as we're seeing now. What they call infrastructure today is, childcare, uh, you know, free college education, um, bailing out pension funds. That money will come out of every corner of the government into places to deal with what the bust caused. The problem is they treat it like free money. They think, oh, gee, we're, particularly in the bust, rates are going to go, like I said, I see the 10-year going to 2.5%. In the bust, I see it going to zero. So it'll drop. The rate will drop because of deflation, because of the bust. The rate will drop down to zero or close to it, maybe even negative rates. They're going to look at it during that time as something that's free money. We don't have to pay any service costs on this. There's no interest rate. So it's that MMT argument. Oh, gee, we can keep this going forever because there's never any cost. Well, the cost comes with a lag, and that cost is the inflation, because of that overstimulus. And when inflation starts moving back into positive territory and then starts accelerating towards 5%, and then high single digits, and then double digits, and then ultimately by the end of the decade, 15 or 20%, how does the government pay for that? They're going to have to pay the interest and service on that debt, not at zero, not at 1%, not at 2%, but at double digit rates. It bankrupts the government. So that's why I say when you get to the end of the 2020s is when you run into the true collapse of the system, because you've created a Ponzi scheme that is now collapsing.
So I want to talk about that, right? Because I'm 29. I got a 9-month-old baby. And so I'm very interested in what the future looks like. And I go, all right, so what happens then? I mean, obviously nobody knows, but what is your best guess when you say a collapse of the Ponzi system, of the Ponzi scheme that can't go forever? So does the global power shift to another country, and the USA just becomes basically a country that it becomes a banana republic that doesn't produce anything? I mean, what does it look like? What happens to the dollar? And I mean, when you're printing that, Is there a point at which people lose confidence in fiat currency? I mean, what do you think this all looks like?
Okay, so um, I'll start with the dollar. I do think the dollar, by the time we get to the mid decade, so say 2025, I think, and probably it'll begin rolling over before that, but the dollar will begin. I have not been in the loss of reserve status camp. I think the dollar remains the reserve currency for a while now, a while forward. So, I think the dollar can run up in the bust because we're still looked upon as the strongest country out there and the stablest. So when a global bust hits, and again, it's global, people around the world are going to flock to the dollar for safety. So I have a call on the dollar to run down to 85 and probably down to 82 here in the next several months. And then during the bust to take it all the way back up to say 120 or even higher. So the dollar has another, I'll call it another hurrah in it, one last run in it that will carry it into 2023 probably, or certainly through 2022. But beginning somewhere out there after that, it begins a long decline where I think by the end of the decade it's south of 50. So it is going to be a problem for the U.S. But that being said, remember, this is a global bust. This entire scenario I described is across the globe. It's China, it's Europe, it's Canada, it's Australia. Everybody's going to be, facing, and some worse than us, the real blow up of the system. So when we get to the end of the decade and we really have the true unwind of what we've built up for the last 80 years, I don't know what comes out of that. Well, I fear that it's totalitarianism, not just here but around the globe. I fear that. I think it's not going to be. I am not in a Pollyanna. Don't have a Pollyanna view where, gee, we can have a reset and clean out all the debt and start fresh. It's not going to be that. It's going to be. I mean, it's going to be a collapse of the system, and that means a collapse of Social Security system here in the country, a collapse of Medicaid and Medicare. So there's going to be no real, if the government's bankrupt and has no access to capital markets, because people say, we don't want your debt, you didn't pay on the last debt you issued. You're not going to have stabilizers there to feed people, to people that are out on the streets. You're just going to have massive unemployment with no welfare system. So I don't mean to put all that out there. It sounds crazy, but that's from standing back from 10,000 feet and saying, where are we headed in the big cycle? That's where I think we're headed.
Yeah, well, I'm hoping by then that I'm going to be able to have an extra spacecraft and we can just head out. So let's wrap up here with give us an idea of where you think over this inflation trade, where you are focusing on and where you think are important places to be parking money. Is it gold? Is it silver? Is it commodities? Is it mainstream equities?
Yeah, as I always caution people, I'm a strategist, so I'm not allowed to advise, not allowed to make recommendations. So you got to kind of derive it from my forecast. But here's what I would say: in this period where I've already given targets for the indexes, I think the S&P can easily get to 4,700, and it could be 5,000. Once you get into this parabolic, what I call parabolic MeltUp, it's going to go straight up, and it's going to be pretty amazing how much ground gets covered in a short period of time, whether it's in May, June, or whether it spills over into July or even August. But I think it's probably more likely May, June into early July if it extends. So you could see from 4,100, 4,200, you could see it up to 5,000 easily. In that period, I think the leadership is typically when you're in a cycle like this, a market cycle, leadership remains right to the top. So leadership of this cycle has been technology and healthcare. I think that continues to be the case. But now you're getting some of those things that underperformed for many years in catch-up mode. So you have commodities starting to perform. You have, so-called opening up, um, the economy opening up type trades performing, airlines and things that were shut down by the pandemic. You got catch up in those. So you're going to see a very broad rally, in my opinion. So a lot of things will work. A lot of things will perform. I continue to say the FANGs and the semiconductors will lead. I think the industrials and commodities will perform very well, but it doesn't rule out biotech doing pretty well. The place that will likely lag will be the defensive areas like utilities and staples. Um, that's for this run into a top. Once you get on the other side of that, I believe it's going to be a very broad bear market. As I said, let's say we take the S&P to 4,700 or even 5,000. You could be down at 1,000 at the bottom of the bear market. That's an 80% drop essentially. I think it'll hit most everything. Defensive groups like utilities will go down less than will technology, et cetera. But it's just, you're going to go up and then you're going to see a pretty big swoon on the way down. That bear market could, I don't know this, but I think it could be faster than 2008-9. So, you could see peak to trough decline happen over a matter of months, 3 to 6 months. So that would be, if we get that kind of a drop in that period of time, that will be stunning. And depressing. But I think the precious metals are just coming alive. They started to come alive, within the last week, and then we got hit hard yesterday. And I think probably a lot of the people that are skeptical of a metal rally because they've been so underperforming for so long, probably got discouraged yesterday. But I think the market's just trying to keep people off balance. And so I think we've begun what I think is going to be a pretty big leg up in precious metals here. My target for this year for gold is 2,500. For silver, it's 45 to 50. So those are big moves if we see that. But generally, I think it's and I tell people I can't advise. I'm not telling people to be in or out of the market. Everybody has to make that decision for themselves based on their own risk parameters, et cetera. But what I will say is, in a parabolic MeltUp, which is the last stage of a secular bull market, you cover a lot of ground in a short time. So we could be very close time wise, meaning in a couple months we could have seen the top. But you could cover, in the case of the Nasdaq, you could cover 20% or more in that 2 months. So it's and that's typically several years worth of return. So it's just be careful out there. I would caution people that there's going to be an awful lot of voices out there telling you to do one thing or do the other. You just have to do what makes sense for you. What I call it the sleep at night quotient. You gotta realize we're at the late stages of a bull market. That means the risks are rising. The returns can look pretty good in a short period of time. Just don't get too caught up in it.
Absolutely. So thank you for joining us today, Mr. David Hunter. Link right there down below to David's Twitter, and you can send him a message for his newsletter, which is right there down below. Make sure you hit the like button on this side or that side, wherever you find it, to send this out into the YouTube universe so more people see the video. Make sure you hit that subscribe and that bell notification if you are new here to get notified for new videos. And just want to say thanks very much for coming on, David.
Yeah, thanks, Jake. Enjoyed it, and I look forward to seeing you again.
Awesome. So give us a comment down below that says David Hunter rules, and make sure you go follow him over on Twitter. And thanks to our channel sponsor, which is Vizsla Silver. So have an absolutely great day. Thanks for watching this video, and we'll catch you next time.